Before I start this week's episode, Andy, I just want to say a quick thank you to our sponsors, Fidelity International. And whether you're just starting out or an experienced investor, Fidelity offers a range of investment options with plenty of information, tools and guidance to help you make more of your money and achieve your financial goals. For more information about Fidelity, please visit fidelity.co.uk/money to the masses. And do remember, the value of your investments can go down as well as up, so you may get back less than you invest.
Hello and welcome to episode 409 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leaks. Damien, how are you doing?
Well, I've got to start by apologising because you can probably hear that I'm developed a stinking cold this week, and there's nothing worse than listening to somebody with a cold talk. But there's so much that's been going on this week, including the budget and a potential financial crisis, that there is no rest for the wicked, as they say. But I'm hoping my voice will hold out for the entire episode this week, Andy. And if you want to hear what I sound like when I haven't got a cold, don't forget you can go and watch our Grow It campaign. We're already, by this point, we're up to episode 5, and we're going to be going on to 6 next week and 7, and the entire series is 10 videos long. So make sure that you listen out for that, or you watch it on YouTube.
Okay, so we'll get to what's coming up in this week's show in just a second. But before we do that, let me just quickly read out a review that we've received, and we'll be reading a few of these reviews over the coming weeks because they are coming through. So thank you for that. Don't let that deter you though, because we are giving away, of course, Money to the Masses mugs if you submit your review and then let us know which one is yours. So this one says life changing from Melaquestia. And they say, thanks to Chartered Financial Advisor Lisa Conway Hughes, who recommended her readers to listen to the podcast in her book Money Lessons, I discovered this incredibly life-changing podcast on all things money. Having been totally clueless and overwhelmed on any topic relating to money and in a dire situation managing my finances poorly, this podcast is full of wisdom and digestible content and guidance on managing money and all its diverse and important layers. It's an invaluable resource and I'm thankful for it. It's so helpful to have something I can listen to on my commute and at the same time gain knowledge which can then be put into practice and benefit my well-being now and in the future. That's pretty cool. So Damien, you're in a book.
Well, it turns out I am in a book. I didn't even realise. I think that book, when I looked, was published a few years ago. So that is great. And funny enough, it's a bit like buses, because this week I found out that I was in another money book quoted. Claire Barrett from the FT has published a book this week. I'll inevitably probably talk to her about that book, but it's always nice to be given a mention and a nod from other people within the profession. So Andy, I'm going to jump straight on to what's on this week's show before I cough or sneeze. Now, it's been a big week. In fact, we've got the budget. So we had the spring budget with quite a raft of announcements. I'm doing a whole section on the pension announcements, and you're going to be doing a piece on the general roundup of all the other things that were announced, including changes to childcare and energy support. But the first piece on the podcast, I'm going to explain what's been going on with the banking system and bank stocks. They've been plummeting. You'll see headlines about banking crisis and a potential financial crisis. So I'm going to delve deeper into that topic.
Okay, so let's start with the first piece then, and let's start with the impending financial crisis. What have we got on this, Damien?
Okay, so the first piece on the podcast this week is in relation to what's going on with the banking sector. There seems to be a banking crisis and possibly an unfolding financial crisis. I want to explain what's going on and explore that a bit further. Now, I am going to be very high level. You've got to realize that this story is very fast moving, and like all of these potential black swan style events, often you only really find out what happened with the benefit of hindsight. So what I'm going to do is have a high level discussion around what we know at the moment. Yes, there are going to be some assumptions. There'll be other things that we'll probably learn that might contradict some of this, but it will give you an understanding of what's happening in the banking sector right now. So if we go back a week, so March the 8th, there was a cryptocurrency focused bank called Silvergate Capital. Now, that announced that it was going to cease operations and liquidate its assets after a bank run. Now, that was a relatively small story. Not many people would have been aware of it. Where things suddenly escalated was when Silicon Valley Bank hit the headlines. Now, you probably haven't heard of Silicon Valley Bank. I hadn't heard of Silicon Valley Bank. I'm going to call it SVB for short throughout the rest of this podcast. But to give you an understanding, SVB whose parent company is actually called SVB Financial Group, is a tech-focused lender and claims to lend to almost half of all venture capital-backed startups in the US. So VC for short, we'll use that when referring to venture capital. Now, what that means is if you imagine the tech companies out there, somebody might be launching some amazing new service, they have to go and get backing, so funding, and they'll get it from venture capitalists. So that will be VC money. Now, what often happens is they get that funding, it can be millions and millions of dollars. They will need to put that money in a bank account, obviously, and sometimes it can be tricky getting a bank account with a mainstream bank for money laundering reasons and just because of the administration that goes on. So SVB had actually created a bit of a niche for itself by having a lot of tech companies as customers. So all of that VC money, and there was billions of pounds worth of it, was put with SVB. So its assets grew very rapidly. Now you've got to think that its customers are tech companies. And if you have been listening to any of these podcasts or the market updates I do, or you read the 80/20 investor newsletters, you will know that the tech sector has struggled over the last year. And that is largely a result of the rapid rise in interest rates from central banks. And in the case of America, it's the US Federal Reserve that's hiking interest rates. So that has put pressure on these businesses. Now, it's useful to go back to podcast episode 371, where I talk about duration, and podcast episode 365, where I talk about the flaws of index-linked gilts, because I talk about duration in there. And essentially what happens with duration is that it's a measure of the sensitivity to interest rate moves. So if you imagine you're a tech company and its profits way off in the future, because a lot of these companies are very aggressively growing, but the payday from an investor's point of view is off in the future. When you discount that back to today, and that essentially is what a share price is, the interest rate you discount back at will influence the share price. Now, if you think about it in reverse, if you put money in a bank account and you had a very high interest rate, it will grow to a very big number way off in the future. If you had a very low interest rate, then it will hardly grow at all. That concept, but in reverse, if you discount a pool of money in the future at a high interest rate, then it means that the current value now will be smaller. That means for technology companies, when interest rates rise, you tend to see their share price, assuming that share prices are in effect a discount of future earnings and profits, then that means that share prices in tech companies have fallen hard over the last year. And you can see that if you open up your stock market apps, or if you've invested in tech companies in any way, you will see share prices have plummeted. Now, tech companies have also struggled because the cost of debt has been going up over the last year rather aggressively because of the interest rate rises in the economy. It does therefore also mean that VC funding has dried up. And what we've seen is these companies that burn cash very quickly, if they've not been able to secure more funding, are having to tap into their money on deposit, so in the bank accounts that they have, to be able to pay their bills, to pay their staff. Now, from SVB's point of view, that meant because their client base was very focused on these VC-backed tech companies, suddenly lots of their customers wanted to pull money very quickly out of their bank accounts to be able to stay afloat. Now, what's happened, and it's partly a result of the financial crisis back in 2008, there are rules in place about the assets that banks have to have on their balance sheets in order to effectively be able to provide their customers with money if they want it. So if you imagine they've got to have this cash, but they can do certain things with it. They can buy certain types of asset which will be deemed liquid enough so they could fulfill their obligation if their customers want their money back. Now, where this gets slightly complicated is that those assets that the regulators, for example, in America, allow to be held include certain types of bond. So those bonds, which are ordinarily deemed as safe investments, can be liquidated if need be to be able to give clients their money if they decide they want to withdraw money from the bank. Now, things got out of hand and we saw panic around the banking sector occur when SVB came out and announced that it had sold $21 billion worth of bonds to meet the withdrawals that its customers were requesting. And in doing so, it crystallized a loss of $1.8 billion on the investments. And not only that, they would also need to raise over $2 billion in new money to remain solvent. Well, it's no wonder that the share price of SVB Financial Group, that's the parent company, plummeted 60% on the news. And this then sparked a whole contagion fear. But why the panic? Obviously, they've crystallized these huge losses. But because of the way the accounting rules work, essentially, the reporting requirements of the banks meant that some of those bonds that they hold, billions of dollars worth, that keep the bank effectively liquid, are visible in terms of their value via their company accounts. But another portion of those huge portfolios of bonds don't have to be reported on in terms of their current value in the same way. And that's because if you think about what a bond is a loan to a company. And so if you had a £100,000 bond, you've essentially given a £100,000 loan to a company. You get interest payments called coupons for the period that you're loaning the money to the company. The maturity date, you should then get your initial loan amount, £100,000 in my example, back from the company. So although bonds do trade, and if people become concerned about credit risk or they don't want exposure to certain types of bonds, so essentially loans to certain types of company, they can buy and sell them. So the price of the bonds do go up and down. But if you hold a bond to maturity and assuming that you actually get paid and the company that you lent the money to hasn't gone bust, then you are going to get your money back and you will have been paid the interest along the way. So in a way, if you hold bonds to maturity, it doesn't really matter what the current value is as long as the borrower doesn't go bust. Now, the reason it's important to talk about duration is because in those past podcast episodes, I talked about bond duration. And in a low interest rate world, then bond duration isn't so much of a problem. In fact, bond investors might take on more duration risks. So duration is a measure of that sensitivity to interest rate changes. So if you think about it, if there's a 1% interest rate change, a positive 1% increase, and the duration of the bond portfolio that you have, for example, is 5 years, then the capital value of the bonds you're holding falls 5%. So if you were to sell them, you've lost 5%. Equally, if interest rates fall 1%, then the value of your bonds will go up 5%, the capital value. That's that sensitivity. So the longer your duration, the greater the sensitivity to interest rate changes. So in a world where interest rates were ridiculously low, don't forget we were on 0.1% interest rates in the UK, for example, only 18 months ago, then your sensitivity to interest rates is less of a problem. And many people would take on duration risk in the management of their bond portfolio to try and increase returns. Well, part of the question mark around SVB and potentially other banks is how those bond portfolios be managed. There's talk of mortgage-backed securities being involved. If you recall, that was something that was a problem back in the financial crisis of 2008. What it means is that these bonds that are a part of the bank's balance sheet that enable it to stay liquid have apparently fallen in value significantly. And that's because interest rates have been increased by central banks like the US Federal Reserve. And as I mentioned earlier in the show, you just have to look at any bond fund over the last year and you can see its value has crashed. 2022 was a terrible year for bonds. In fact, I think it was one of the worst on record. Look at a gilt fund, you're probably down about 20-something%. This is the sort of thing that's unheard of. Now, what the forced selling of their bond portfolio by SVB did was when they crystallized those $1 billion worth of losses, it suddenly made people realize that lots of banks holding portfolios of bonds that effectively are meant to meet the liability if all their customers want their money out of the bank, have they plummeted in value, partly because of rising interest rates, partly because of mismanagement. Suddenly, you've got a case of what don't we know about? And then this fear of contagion that the whole banking sector was sitting on some huge paper losses, and if all their customers wanted their money out, the banking system would collapse. So that's why you started to see in the last week bank stocks, whether they're in the UK, Europe, or the US, falling by typically between 10 and 20%, and in some cases you're looking at much bigger figures. And just as a point, I've talked about it before on the podcast. Historically, central banks have always raised interest rates like they are now to fight inflation until they break something. So something somewhere breaks and then they panic and they stop and they start to unwind it. And this looks like the potential thing that they've broken this time around. So then what happened is SVB was put into receivership, making it the largest bank failure since the financial crisis in 2008. Now, no matter what central bankers say or presidents try and calm things, that is obviously a concern. And of course, the idea of a banking crisis and a potential financial crisis then started to cause assets to sell off in terms of equities. But interestingly, bonds did the opposite, because obviously if we have a financial crisis, we like to go into a very deep recession. And so bonds become more attractive in that way. Gold rallied. And we saw bets in terms of central banks' ability to keep hiking interest rates, they started to change as well. And the market started to bet that actually interest rates might not go any higher and we might start seeing cuts sooner rather than later. But it meant that the rug was pulled out from equity markets globally. The epicenter was banking stocks, but it was a much wider phenomenon. And you will see that there are moves in bond markets that are multi-decade records for like single one-day moves in terms of bonds, in terms of equities, in terms of a whole range of assets. This isn't normal. So we actually got to a stage where the fear rose so high that the Federal Reserve, the Treasury Department and the FDIC announced in America that they would ensure that depositors of SVB and Signature Bank, that I also mentioned, would have full access to all their money. But it got to the stage where the FDIC invoked something called a systemic risk exception. Ultimately, it allows the US government to pay back uninsured depositors the full value of their money without the taxpayers having to foot the bill. Now, the reason this is important is because if you think in the UK, we have the Financial Services Compensation Scheme. If you have in a single account £85,000 or under, if the bank goes bust, then you basically get your money back. There's a backstop there. Well, in America, there is an equivalent system and it's $250,000. And all of this came about through lessons of the financial crisis in 2008. But what's happened in America, which is very interesting, is by essentially saying that uninsured depositors, because don't forget, at SVB, there were companies with millions and millions of dollars deposited in accounts with SVB. They would only get $250,000 back if the bank went bust. Suddenly, they are guaranteed to have access to all their money and get it back as well. There's no problems. Well, there is an argument that if they do that for these two banks, wouldn't they have to do it for every bank? And hasn't the government essentially taken on trillions of dollars worth of liabilities in that way? I mean, it's something up for debate. But that just shows you where we are, that previously, the level at which you would get money back was $250,000 if the bank went bust in America. Seemingly is almost becoming unlimited. So there are some eyebrows being raised about that. Now, of course, that started to create some calm within the markets, but there is still these fears about contagion, and it's now crept into the European banking sector. And I'm going to talk about Credit Suisse in a minute. But one of the things that has also been talked about, that it may be beyond just this whole bond idea that's the real cause of it, the mismanagement of the portfolios they had that would ultimately keep the bank liquid. But technology could be at fault as well. Because if you think about it, as you're listening to this podcast, if you wanted to move all your savings from one bank to another, you could do so at the touch of a button. That didn't happen in the past because you'd have to go to a bank, you'd have to queue up, you'd have to fill out forms or whatever. But the systems in place actually created friction. Whereas now you could have billions of dollars worth of money move from one bank to another almost in an instant if somebody sparks a fear about the liquidity of a bank. And of course, that's a bank run. And that did kind of happen with SVB. There were some VCs who started to tell clients to pull their money out of SVB. And of course, that's what sparked that run. So there is another thing that is worth thinking about in the modern era. There is technology part of the problem as well when people start to move money around. And the other thing is, in a world where interest rates were so low, we weren't getting paid hardly anything on our money anyway. But when interest rates get to 4 or 5%, people start to notice that they're not getting a good deal and start to shop around and start moving money about. And of course, what happens with companies even do that. And if you get companies with millions and billions of dollars doing it, then you can start seeing money move across the system very quickly. And actually, there's an argument to say that was kind of happening anyway to companies like SVB, where money was being moved to other areas that were paying a better return. And so although all the problems seem to happen very quickly, perhaps it really was a drip, 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 and then eventually the dam broke. Now, what I want to do is just quickly talk about Credit Suisse, because that has been hitting the headlines this week as well. Now, Credit Suisse is a Swiss bank that has been having problems for a very long time now. This isn't something new. If you look at the share price over the last few years, it's been plummeting. But in the last week, we've been seeing moves like 30-40% down on its share price. And part of that has been fears of contagion, but also that the bank might be under extreme stress. And you started seeing bets within the financial market via instruments, and not people like betting like at the bookie, but via instruments you can infer the probabilities. They were actually putting a probability of about 30-40% that Credit Suisse would default. In the end, the Swiss central bank came to the rescue and gave them a $54 billion loan as a liquidity injection, which just seems to, for now, calm the market, although there are signs that the market is still very concerned. But what sparked a lot of the problems this week was the fact that the Saudi National Bank, which invests in Credit Suisse, had said it wouldn't inject any more money into the struggling bank, and as a result, that caused the share price to plummet. Now, there is this weird doom loop that also occurs with stocks. Now, again, something that's a little bit technical, and we don't want to get bogged down into it, but there's something called contingent conversion bonds, COCO bonds. Essentially, that means that these certain type of bondholders have an ability to convert their loans into equity if the bank, or in this example, a bank, is under stress. Now, of course, that gives them less protection because they go from actually being somebody who's lent money to the institution to actually having a stake in it. And if it's collapsing, that's not necessarily somewhere you want to be. But of course, what happens in this scenario is when a share price gets hammered as quickly as it does, as it did with Credit Suisse, people who hold these types of bonds are worried that they're suddenly going to become a part owner in the business that seems to be unwinding. So what they do is to hedge against that is they start shorting, they start betting against the price of the share in Credit Suisse, for example, because they could end up owning it. So what they want to do is protect themselves from further falls. So they start shorting it. And ultimately, that means when you start shorting it, it puts downward pressure on the share price. So you get this weird doom loop that happens, that once the price starts falling, it starts being amplified and going into a doom loop. So we've got all of these things going on in the finance market. So there's a lot that I've mentioned there. And I hope people have got a bit more understanding as to what's going on. As I said at the start, there's so many things that I can't cover, some things that are even beyond our understanding, really, what's going on in the banking sector. But the question is this going to turn into a full-blown financial crisis? Now, you would have heard some of the things I mentioned about records in terms of moves in stock prices or banks failing or whatever it may be. But one thing to point out, how often do financial crises occur? We had one in 2008. If you look at history, they happen roughly every decade or so. That means that we've been on thin ice and basically waiting for one since 2018. We're now 2023, so we are overdue a financial crisis. And so could this go into a full-blown one? There are people out there who are saying, no, it won't. There are people out there already saying, yes, it will do. And it already is, because given some of the extreme measures we've seen early doors, then regulators and central banks must be pretty concerned. But of course, there's the other school of thought which says that they're acting fast now as a result of their learnings from previously. One thing that does hold true, you don't want to be the first person who claims that a banking crisis is over, not from an ego perspective, but more from a monetary perspective, your own wealth, because if you start betting that it's over, then it has a nasty way of surprising you. So the message at this point of the podcast is to give you an understanding of what's going on. We don't know where it's going to end up, whether this will blow over or not. Central banks are continuing to hike into this regime, which is obviously a concern. It'd be a bit like accelerating into a wall. The ECB, the European Central Bank, has raised interest rates today as I make this podcast, which surprised some people. They thought they'd hold back from that. But what I would say is that as an investor, as a saver, just ensure that your funds are protected fully by the Financial Services Compensation Scheme. So in the UK with deposits, that's £85,000 per banking licence. So don't forget people like First Direct and HSBC share a banking licence. So if you had money with each, it's the combined total can't be more than 85,000. If you've got joint accounts, it can be £170,000 that is protected in those accounts. I'm going to put a link in the show notes to an article on our site that explains the Financial Services Compensation Scheme. But it's just a good reminder about the importance of ensuring your diversification of your cash and your holdings. If you have enough money that is above £85,000, there will be people, especially if they're retired, who might do. Then make sure you stay within those limits. I remember working through the financial crisis in the finance industry, and it was amazing the panic that went off once we started seeing things fail. and people trying to move money around. And I've always maintained since then, and if you listen to this podcast regularly, you'll hear me talk about it, about that importance of the FSCS and that protection, because you just don't know what's going to happen. And financial crises do occur, as I say, fairly regularly, every decade or so. And the other thing, just to stop people having sleepless nights, is that if you are a long-term investor, then you are going to live through a whole wave of financial crisis, probably, depending on your age, of course, before you get to retirement. So this one will pale into your distant memory compared to maybe the next one or the one after that, a bit like what's happened with the 2008 financial crisis. So there you go, Andy. It was quite a long piece, but I like to think something that informed people about what's going on.
Okay, so let's move on to the second piece of the podcast then, and we're going to be talking about pensions now. There were some big changes announced in the budget this week. Damien, you're going to be covering some of those and the potential fallouts from it.
Now, everything I talk about in this section is in an article on the Money to the Masses website. As usual, there'll be a link in the show notes where you can go through and read the full article. Actually, we do have articles for a roundup on the budget itself and more details on the childcare changes, as well as details on the continuation of the current energy price guarantee. But there was quite a bit announced in the budget regarding pensions. Now, in the past, there's always been rumours ahead of any budget or autumn statement whether the government would actually reduce the annual allowance or make pensions less appealing. And in fact, what's happened, for the wealthy at least, they have become more appealing. So I'm going to rattle through these changes and just tell you about some of the implications. Now, the first thing that was announced, which really was the one thing that really caught people by surprise, was the abolition of the pension lifetime allowance. It's currently set at £1,073,100. Now, the lifetime allowance won't impact most people. For those of you who don't know what it is, it's basically a limit on the amount of pension benefits you can build up over your lifetime and still enjoy the full tax advantages associated with a pension. So if you exceed this amount, then you are liable to a tax charge of 25% on any additional income from your pension, or 55% tax charge if the excess is withdrawn as a lump sum. Now, that sounds like a huge number. It is, but it doesn't just apply to defined contribution schemes, so those schemes where you put money in and you grow your pot. It also applies to final salary schemes. And what happens is at key trigger events, your pension benefits are tested against this lifetime allowance. And for final salary pensions, there is a multiple that's applied. So it's 20 times the pension benefit you're going to receive a year. So you can see, therefore, how a final salary pension for somebody who's very well paid could very well exceed that 1 million mark. Now, what was announced in the budget is that the tax charges that I mentioned are going to be removed from April 2023, but the whole lifetime allowance itself is going to be removed probably April 2024, but it's got to go through a finance bill first. So that has big implications for the very wealthy in society, because I remember going back the years when I was in the finance industry, we were always having to look at the lifetime allowance for wealthy clients, trying to ensure they didn't breach it or what protections they could put in place. Now that has been removed. So for those people, it's obviously a big positive. It therefore only really benefits the 1% wealthiest in society, if you believe the numbers that you see in the press. But the logic apparently behind why this will be removed is that there are doctors and surgeons, for example, in the NHS who earn good money but are either reducing their hours or retiring altogether because they would be breaching this lifetime allowance. So the tax implications were causing them to decide they would actually retire earlier rather than continuing on in the NHS. And of course, we have a problem in the NHS with the numbers of doctors, etc. So the plan is that that's meant to encourage them to continue to work. Whether that will happen, we'll have to wait and see. But of course, it just benefits anybody who has built up large pension benefits, whether it's in a defined contribution scheme or they've got a very generous final salary scheme, and those who are among the wealthiest in society. Now, the other thing that was actually announced was the increase to the pension annual allowance from £40,000 a year to £60,000. Now, that's going to come into effect from April 2023. Now, you will recall that the annual allowance refers to the amount you can put into a pension each tax year and receive the full tax relief. Now, at present, you can put in up to 100% of your earnings up to a maximum of £40,000 in a given tax year. That is going to increase to £60,000 from April, as I've already mentioned. Of course, there's still carry forward relief, so you can use past unused allowances if you want to contribute more than £40,000 currently or £60,000 in the future. Just bear in mind that if your earnings are lower than £40,000, then you're entitled to tax relief only up to the amount you earn. And if you earn less than £3,600, you can pay in £2,880 and still get tax relief. There's no evidence that that rule has been changed. So the winners on that front, again, are the wealthiest who can afford to put that much into their pension, but also perhaps people who have deferred paying into pensions and have left it later in life. They can therefore perhaps catch up a little bit better. An example I'm going to pull off the top of my head, it could be somebody who runs a business, for example, who has not funded their pensions, instead focusing on growing their business. They might decide to then start funding their pensions by as much as they can going forward once their businesses are stable and they are maybe in their 40s or 50s. Now, the other change is the money purchase annual allowance. So this is the reduced allowance that you get if you've already accessed your pension benefits. It's not if you just take the tax relief. I'll put a link in the show notes to explain what the money purchase annual allowance is. But if you're starting to basically draw income from some of your pensions, then you will have a reduced annual allowance. It did drop down to £4,000 a year. The idea was to stop something called pension recycling, which was where people took from their pensions and put it back into a pension to gain tax relief on the money. So that limit is going up from £4,000 to £10,000 a year. And also there is a tapered annual allowance, which currently means that if you have an adjusted income over £240,000 a year, for every £2 of income earned over that limit, your annual allowance is reduced by £1. So the tapering effect means that you can get down to a lower limit of £4,000 a year, which happens to be the same as the money purchase annual allowance. So that means the highest earners were capped to how much they could put into a pension. That is also increasing to £10,000 a year. And the limit level that I mentioned, £240,000, is increasing. That threshold is increasing to £260,000 from the 6th of April 2023. Now, one thing to mention, the pension carry forward rules, they still won't apply if you've actually triggered the money purchase annual allowance. You won't be able to carry forward, but you still can if you've got a tapered annual allowance. So what does this all mean? It basically means that people who are the wealthiest are going to benefit the most from these changes, but it is also meant to be aimed at encouraging people to continue working if they've started to draw their pensions. So if you look at the numbers, if you had £4,000 as a money purchase annual allowance, so you started drawing down on your pension, getting income, you continued working. If you earned £50,000 a year, then your employer and your own employee contributions under auto enrolment would total 8%. That's if your employer didn't actually match your contributions, they just did the bare minimum. That would equate to £4,000 a year. So it means that if your employer has a more generous contribution matching policy, or you earn more than £50,000, you could very quickly hit that money purchase annual allowance currently. And so you would be liable to a tax charge, which means that people would start thinking, what's the point in continuing to fund pensions or indeed go back to work? So by increasing it to £10,000, then notionally that's going to help people who do want to start drawing on a pension to be able to continue working and to continue to fund a pension as well. But one other aside that I just wanted to highlight is with the removal of the lifetime allowance, they are going to set the maximum tax-free cash that you can take from a pension at £268,275. That's 25% of the current lifetime allowance. So for most people, the amount they can take from a pension is 25% of their fund tax-free. But what's interesting about that is because the lifetime allowance has been abolished, they're now technically putting a pounds and pence limit on the size of the tax-free cash people can take from a pension. Well, it won't impact many people, but in time with inflation or a future government deciding to reduce that number, that could be something that starts to impact more people, because we're at the moment, if the rules go through as they're saying they're going to go through, the maximum tax-free cash you can take is £268,275 from a pension. Who's to say that future government won't start to reduce that down as a way to generate more tax, in which case it will start to impact more people. So the one thing to just bear in mind is that the Labour government has already come out to sort of suggest that it probably will reverse some of these changes if it gets into power in the next election. So still things are slightly up in the air, but there has been positive changes to pensions for, unfortunately, just the wealthiest, really. But for those who are funding later in life, there is a small bit of good news there.
So let's move on to the final piece of the podcast then, where I'm going to be doing a quick roundup of everything else that was mentioned in this week's spring budget. And Damien has obviously already gone through a lot of the implications of the changes that were made to pensions. So I'm going to focus on the other things that were mentioned in the budget that affect workers, motorists, families, and then finally touch on some of the smaller bits that were announced to do with businesses. So aside from pensions then, there were a couple of announcements which is likely to impact those that are looking to get back to work, namely the introduction of a £400 million plan to increase the availability of resources for those people suffering from mental health and musculoskeletal conditions. There's also been some changes made to how sickness benefit payments are assessed, meaning that claimants can continue to receive a proportion of their benefits after returning to work. And the idea is that that will help facilitate and incentivize those that are currently receiving certain benefits to return to work if they were able to do so. A new programme which has been labelled Universal Support has been launched in England and Wales, which is a voluntary employment scheme for disabled people, which will provide up to £4,000 of funding per person per year. And it provides support they need to get back into employment. And it was mentioned that that programme will be able to fund 50,000 places a year. And just finally, while we're talking about the impact that this budget has had on workers, as expected, personal allowances have been frozen, which again has pushed more workers into higher rate tax bands. And we've covered in the podcast before that by freezing personal allowances and pushing more people into those higher tax bands, it actually raises more revenue for the government. It's often referred to bracket creep or tax creep. And so essentially workers will be paying more tax in the coming years as those personal allowances continue to be frozen. And so moving on to how the spring budget has impacted families, there was a big announcement on free childcare, with the current scheme being broadened, meaning parents of 1 and 2 year olds will soon be eligible for up to 30 hours of free childcare per week. It's available to households where all adults are working at least 16 hours per week and can be accessed from when the child reaches 9 months. Currently, the rules dictate that parents only get free childcare once their child reaches 3, and it's between the ages of 3 and 5 before they go to school. This new plan will be introduced in stages where working parents of 2 year olds will be able to access 15 hours of free childcare from April 2024. And then it will be extended to all children from 9 months old in September 2024. And then from September 2025, a year later, it will be increased from 15 hours of free childcare to 30 hours of free childcare for those with children 9 months and older. And again, in order to qualify for that, all adults in the household must be working at least 16 hours per week. There's also been some changes in terms of parents receiving universal credit. They'll now be able to receive their childcare funding up front rather than having to claim it back. There has also been a change to the monthly cap for those that claim universal credit. It was previously £646 per child. That's been increased to £951 or £1,631 for 2 children. And finally, on childcare, it was announced that there's going to be additional funding to increase the supply and availability of wraparound care, with the aim that all schools are able to provide a full wraparound offering by September 2026. So you can see that a lot of these measures are designed to help facilitate the return to work for those parents of young children that wish to get back to work. Moving on to energy, the energy price guarantee has been extended for a further 3 months, meaning it's now going to end in June 2023 rather than April as originally announced in the autumn statement. And we got details on the energy price guarantee and exactly how that works on the website, and we'll link to that in the show notes as usual. There were some changes also to the charges that are made for prepayment meters, and the charges for those will be brought in line with comparable customers on a regular direct debit plan. And that's particularly good news for those who say are in rented accommodation and are forced to be on these prepayment meters. They'll now be able to get the same price for their energy as anyone else on a standard tariff that they pay for by direct debit, which is good news. In terms of changes for motorists, the 5p cut to fuel duty has been maintained, with a further freeze on fuel duty rises for another 12 months. And Jeremy Hunt said that that would save the average driver around £100 over the next 12 months. And there's also been a boost to the potholes fund, which I didn't realise was a thing, but apparently every year there's £500 million placed into the potholes fund in order to fix the UK's roads. Well, that's been boosted by £200 million. So there's £700 million next year in the pot to help fix the UK's roads. I think from my own personal experience, they probably need at least another 300 million to get that sorted. But there we go. It's good news at least. And finally, let's touch on what the spring statement meant for businesses. £63 million of funding has been given to public leisure centres and pools to help keep them afloat, especially with rising energy bills. Tax duty on draft products in pubs will be up to 11 pence lower than the tax duty on supermarket alcohol. There's increased funding paid to nurseries that provide free childcare, meaning they'll get a £204 million boost from September 2023, rising to £288 million in 2024. A new policy was announced to enable full capital expensing for the next 3 years, meaning that expenses, including IT equipment and machinery, can be deducted in full and immediately from taxable profits. £10 million in funding has been given to charities tackling suicide. And finally, confirmation that corporation tax is set to rise from 19% to 25% at the beginning of the new tax year for companies with profits over £250,000. So there we go, Damien. That is the Spring Budget Roundup.
Right, that's it, Andy. It's a great roundup of what's happened with the budget this week. Don't forget, as we've mentioned, there are links to everything we talked about in the notes of this show. You can find out more information. As ever, do make sure you join our Facebook group, facebook.com/groups/money to the masses. And of course, as we mentioned at the top of the show, please do leave us a 5-star review for the podcast on whatever app that you use. So that is it for this week, Andy. So all that's left to say is until next time.
Until next time.